please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
You're with us here on a fresh new edition of Trading Hour. I'm Prashant Nair. With me is my colleague Ekta Batra. The markets are recovering. They're up about 30 odd points or so, if you can call that a recovery after the kind of sell-offs that we've had Monday and then last week, late last week, Thursday and Friday. Friday more than Thursday. But for now, it's not looking, I mean, at least it's not a one-way sort of market that we have. There is some pushback which is being offered from various quarters. Some recovery, I mean, was expected. I mean, after very sharp corrections which run 3 or 4 days, there are bounces which come. How far they will go, I think, remains to be seen. For now, we are back about 10,100, 10,124 is where the Nifty is trading at. The Nifty Bank has also just about managed to come back into the, not quite, we're still down about 7 points in the index, but it's quite a bit of the lows as well. So, I mean, with that little bit of green, we are starting this edition of Trading Hour. Ekta, morning.
Hi Prashant, absolutely. You know, when I sent all of my graphics in terms of what we do generally in terms of an opening chat, I think that's become outdated because we've seen an advanced decline ratio in fact recover to a positive terrain as we speak. So currently the advanced decline ratio is at least even keel, and maybe the graph should come up for you to be indicative of what exactly the traction is in the mid-cap segment or the mid-broader markets. So you can see that crisscross which is taking place, and let's see whether the advancing stocks, which is basically the green line, is probably going to overtake the red line anytime soon. Currently stands at around 1:1. We started off with a weak advanced decline ratio, so that should be something to watch out for. Otherwise, a lot of stocks in focus, the likes of Cipla, Canara Bank, GSPL, Gujarat Gas, all of these stocks buzzing around in today's trade. But let's get talking on some on some data that you've been pulling up, Prashant.
Yeah, you know, so we kind of have stopped talking about this, I think after, I mean, I've not looked at it since 2012, 2011, 2012. And before that, you had to go all the way back to 2007, 2008. I'm talking about LIBOR, the London Interbank Offer Rate. You know, the one indicator which I think is getting talked about quite a bit, and I don't want to sound alarmist or anything of that sort, but the dollar LIBOR OIS spread is now the highest since the European sovereign debt crisis, which was in 2011, 2012. I'll explain what both those mean. What does LIBOR indicate? What does the OIS indicate? And then what you'll understand what the spread is. This particular spread that we're talking about, I think, is now close to about 50 basis points. The difference between LIBOR and OIS, it's about 50 basis points. And it has only been exceeded during the global financial crisis. It's at the level where it was during the depths of the European sovereign bond crisis, as I said, and it's only been exceeded during the global financial crisis. Historically, both these track each other very, very closely. Now, first of all, what is the OIS sort of reflect? It's nothing but essentially it reflects the rate that banks charge each other, but very crucially, banks with direct access to a Fed line. I mean, you know, in the Indian context, it would be like banks which have got a direct access to RBI LAF window, for example. I mean, you know, so in effect, what it would mean is the OIS is very closely linked to the Fed funds rate, because they can borrow at the Fed funds rate and then they can, I mean, add a little bit and lend to each other. So that is essentially what the OIS reflects. The LIBOR it also reflects the rate at which banks sort of, you know, lend to each other at, the rate that they charge each other. But these are banks which do not have access to the Fed. What would the difference indicate? You know, LIBOR minus OIS. It would essentially indicate, I mean, if the spread becomes higher, it would indicate that banks without direct access to Fed are now charging each other a lot higher as compared to banks with direct access to the Fed window, Fed funding window. And that essentially would also mean that the dollar funding market is actually getting tighter. I mean, the dollars in the system are getting a little bit tighter. That is what it would mean. So it is you know, it's an important indicator which came into bearing in the 2008. It really blew off. I think it got to 2.5% or so. In 2011-12, it was a very closely tracked indicator. And now maybe it will become important, maybe not. The silver lining, though, is, and this is very important, there is no contagion right now. We're talking about dollar LIBOR, but you look at pound LIBOR, you look at euro LIBOR, those markets are absolutely stable. So this seems like it's a very specific US issue right now. And one, I mean, if you read through articles, etc., it seems that experts are of the view that this is essentially a result of the US tax reform. So it's a very technical, maybe almost structural kind of shift which has happened, which is leading to this. But you know, the problem could be, even though the damage may be limited, there is no contagion at this point. The problem could be that the spread widening could lead to the dollar sort of strengthening. We've seen historically a very strong correlation, and stronger dollar for longer has, I mean, over the last 20, 30 years meant weaker emerging markets, and there is no reason why that relationship needs to break down. So I'm just sort of putting this out there. And we'll track it. I mean, if this does come into more sort of limelight, etc. But for now, just putting it out there as something to track. Ekta.
Okay, and we have more to track at this point in time. Thanks, Prashant, for that. Sudarshan Sukhani joins in to talk about the technicals of the market. Sudarshan, hi, morning. For the Nifty, we've recovered a tad bit, but what would your call be? Do you think that this probably is a sustainable kind of bounce that we're seeing, or what kind of evidence would you like to see further on?
Yeah, good morning again. See, the Nifty fell from 440 to 1050 today. So that's a 400-point decline. After a 400-point decline, some kind of bear market recovery is possible, which is what we are seeing now. I do not think that this recovery is tradable, which means it is not even actionable. We can just watch it go up for whatever it is worth. The trade here is that somewhere around 10,140, that's a minor resistance, and the Nifty has come close to that level. We should again take bearish positions. Bearish positions should be taken by buying put options. The value of the put option of 10,200 is your stop loss. It's about 120 rupees, and the potential reward is wherever this market goes by the end of this FNO settlement. So the trade is still to be on the short side.
Okay, fair enough. Stocks, Sudarshan?
Well, stocks are a different matter, because with whatever little mild recovery we have, there are some buzzing stocks which we could consider buying, and there are two of them which have been outperformers, Ashok Leyland as well as Jubilant Foods. Only for the day, only for intraday, we could think of buying these two stocks and see where it goes. And IRB Infra is a short sell. Actually, all PSU banks are short sells. Everything that has rallied, all NBFCs are short sells. So the short selling list is so large that I'm just picking up an infrastructure stock, IRB. But two stocks for buying intraday, one for selling. The Nifty is available for shorting.
Okay, all right, fair enough, Sudarshan. We're going to let you go on that note. Thanks very much for joining in and taking us through all of those strategies. We have some more FNO calls. Gaurav Bissa joins in from LKP Securities to talk about what he's strategizing today. So, Gaurav, over to you, stocks as well as in index.
Good morning. For index, I think there can be a bounce back that we can see. We saw that index has given a decent breakdown. It fell below the 200 EMA as well. But with all that thing, we have not seen significant OI addition happening in the Nifty or the Bank Nifty futures. That shows that there has been price correction that we have seen, but we have not seen good amount of shorts getting built. Also, if you look at 10,000 put option, it has the highest concentration. We have not seen the puts getting covered. So there is it generally means that people are not yet panicking. People think that there can be a good support at 10,000 mark, and we can see a bounce back coming in. So on that pretext, I would have a mix of both long as well as short. First recommendation would be buy on KPID futures. Overall, ID space has been quite strong today. It has seen good amount of long positions in the major part of the current series. Small retracement was seen towards 225 levels. Now writing has emerged in 220-25 put option. We can expect a bounce back coming in the name. One can have a stop loss of 225 and buy KPID for targets of 235. Second, we buy on DV's Lab. It has been trading in the range. We saw a couple of days long OI addition was seen aggressively, and then it has been not doing too much. But the long portions that were created a couple of days back, they are still in the system. It is on the verge of giving a good breakout if it holds 1100 mark. With a stop loss of 1088, one can buy DV's Lab for 1125 kind of levels. And sole sell recommendation would be on Cummins. 7 to 8% OI addition happening today. Shorts have been created. Breakdown has been seen in the name. One can have a stop loss of 754. Play for targets of 720.
Thanks very much. Appreciate you joining in. We have to take a very quick break, so let's briefly and quickly do that. By the way, the markets lost half the gains that we started with. We were up 30, we were up 15. Okay, now 18 points or so. So there's a sell-off which is happening. Take a break. We're right back.
Well, for the Nifty, we're up around 18 odd points. It's important to pull up Cipla because that stock is now entirely or predominantly recovered. Remember, at one point in time, and you can see that on the intraday chart, it was down around 6 odd % because I think there was just fear and panic about the fact that they had received 8 observations for their main Goa facility in an inspection which had taken place in Jan. But I think now there is more incremental information which is coming out from the management that yes, they have received product approvals post that inspection having taken place, and that's probably assuaging concerns at this point in time. So that's the reason why you're seeing that stock recover at this point. It's down around 0.7 to 0.8% as compared to a 6% fall that we had seen just in the early hours of trade.
The observations that we put out were also put out for the first time, right? That,
yes.
were they milder than what was thought earlier? Or
see, there is a debate in terms of, say, 1 or 2 observations out of the 8 that might be of concern, how exactly the management would probably respond to them, etc. But and what the US FDA's decision would be on those observations. But the proof of the pudding is that whether you've received product approvals post an inspection having taken place. Because the company has said so. Now again, the timeline of those observations also matter. There's some technicalities in it. If they received an approval in the month of March, then that assuages all concerns. You know, if they received all those four approvals in Jan, then maybe there's a little bit of doubt.
We don't know that yet.
We don't know exactly what the timeline of the approvals are, but I think the street is getting a little more confident about it. But let's go across to Manisha now, who joins in to talk about the draft agri policy. Manisha.
Thank you so much for that, Ekta. Well, yes, there is more work done in the line where it is about the PM's vision of doubling the farmer income. Remember, we did see that Niti Aayog and the state governments meeting in the previous week. And this week, we, of course, are given the Commerce Ministry's draft policy for agri-exports. Just to throw some numbers out, the global agri-trade accounts for $1.37 trillion. And India is a minuscule 2% of that global trade. And the format or the hope is that the agri-exports from India will be doubled by $260 billion by 2022. And there's plenty that has come in in this draft. You also, of course, have proposal to end the MAP and many other export restrictions. There's marketing and promotion of produce in India that is in focus as well. And of course, the post-harvest infrastructure support for smooth logistics. So everything from value addition to pushing it out to produce in India, from infrastructure to logistics, a lot has been talked about. And add to that the point about essential commodities and of course on what should be done about the APMC Act as well. To get more understanding on all of that, we are now joined by Mr. Siraj Chaudhary, Chairman at Cargill India. Siraj, hi, thank you so much for joining us. This clearly has been the need of the hour. We have seen the first draft proposal come in from the Commerce Ministry. With the initial points that are in there, what is your sense? What is of the more priority here?
Hi, good morning, Manisha. Everything very good here. I'm very happy to read what's there and, all the right things said. And I would be very happy if they actually come true. And that's where the concern is that, these are all good initiatives. These are all good directions, but it's easier said than done when it comes to execution. There can be some benefits from certain government actions, setting up a U.S. like Food and Drug Administration agency or creating export clusters. But, where the challenge will be that, these are all the good things that we want to do. But we don't operate in an isolated world where we do everything that we do and people love us for that. The reality is that we compete. And when we compete, we have to be as efficient as the next guy competing with us. And so it's good that we've listed out the 50 unique product, and the district clusters. Essentially, I would want that, when we have to see how competitive we are to the rest of the world in these spaces. There will be certain areas where we have competitive advantages, and we may need to create some more which are within our control. But there could be a lot more where we are not. And the commodities listed are still small enough. They're not big enough, to say that, okay, we will certainly double our exports to what we're talking. Because there is an element of conflict when we say that we want to double the farmer's income and double exports, which means that the farmer needs to be paid more and the exports which compete with the world market will, go through at higher prices. So I think that is the catch that I see, that how do we produce competitively to sell against the best in the world, and at the same time ensure that our farmers' income is doubled.
Oh, well, that point is very well taken, Siraj. But let's talk about the other one, and that really is about produce in India and the value addition. And that is something that the government, even the food processing ministry, has been pushing for some time. What really has been done in that sector, and how would you look at putting the two together?
So some of the things on processing, I think we will need to look at saying that, okay, can we import raw materials and convert them and send it out of India? I mean, that would be one way of doing it. We create port-based infrastructure where we encourage, there are countries which are producing cheap. Their agriculture is more efficient, or, they have easier access to land and every other factor of production. And then we convert ourselves into a manufacturing hub, which would then mean that we need to have good port infrastructure. At the same time, there is a lot that we produce and we can process. So whether it's in the space of the shrimps and the meat, and basmati rice, of course, has been going on. Bananas and grapes have been the Indian success story. It's not to say that things can't be done, but is their quantum going to be large enough to make it, to double the exports is my question. And then when I look at spices and, some of the other more exotic things, we are challenged. I mean, today, while, this talks about getting pepper exports high, today we are dealing with the challenge of Indian pepper prices being low because we are deluged with imports from various places. So I think we will have to look at some of these things case by case. There will be opportunities. So not to say that everything is against us. These measures are good. They are the right thoughts. We need to pursue them, but we need to stay realistic.
I get your point. Quantum, pricing, policy, efficiency, all of that would really come into being. But Siraj, one more question before we let you go. And this really is about the export restrictions, the minimum export price, etc. That, of course, for the longest time has been a tool that the government has been using, whether it is to support the prices or to ensure availability, supply, demand, etc. With that looking to being end, how would many of these commodities really react?
So that's a very welcome direction. We've had cases in the past where, it happened to cotton many years ago. It keeps happening to sugar at times.
Right.
But all the names I'm talking of, the crops that I'm talking about, are the broadacre crops, which are essentially the big crops, where managing the nation's supply demand becomes a priority, and therefore sometimes these restrictions have to be placed to ensure that there's sufficient availability in the country.
Sure.
What they have clarified and needs to be appreciated is that even if the basic commodity is put under restriction, the products made from that will not be. And I think that's important. From a macro perspective, any restriction is bad. But at certain times, seeing the demand, supply, availability situation in the country, the government will be or may need to take certain actions. But they need to be more planned, more transparent rather than ad hoc.
Oh, well, yes. And that would really mean essential commodities and non-essential commodities. The government, of course, will need to segregate that and then take many of those actions. Siraj, thank you so much for joining us for all those details.
Manisha, thanks very much. Mr. Chaudhary, appreciate you joining us with that interesting conversation. The markets are back up being 30 points. That's essentially what the Nifty was doing when we started at 11. So it's actually pretty volatile. We started up 30, lost 15, we're back up another 15, so up 30. 10,125 is where we're at. We take a very quick break, we return and we discuss market technicals. Ashwini Gujral is going to be with us, his top trading bets.